Hey everybody, Ramsey Goodrich, managing partner here at Carter Morse and Goodrich with a quick market update. Terry Hannafin and I just spent 3 days in lovely downtown Las Vegas with about 3,000 of our closest M&A colleagues from around the country and around the world, with more than 800 investment bankers, 900 private equity folks, and over 1,000 other deal professionals who all descended upon ACG's DealMax conference for the last few days. We went into this conference with really high expectations of lots of liquidity coming to the market now that the election is behind us, now that we've come off of several years of challenging situations, with private equity finally releasing their portfolio companies and what we call the silver tsunami, those folks that may have a few more gray hairs than they did a few years ago, and the private markets finally coming to market as well. So we expected a euphoric 2025, something we've been predicting for the last couple of years, just hasn't materialized. But when we got there, what we learned was a hurry up and wait. Lots of folks, in all of our meetings with private equity folks, they were claiming that deal flow was down anywhere from 30 to 50% from last year. Last year wasn't a great year to begin with, so that means a lot. So folks are holding on for a lot longer. Private equity is waiting for multiples return. Normally you buy low and sell high and take advantage of a multiple arbitrage. Now, if you bought high back in 2000, 2001, you're probably going to sell at a lower multiple today, which is somewhat of a challenge. But so we expect to see more continuation vehicles, more liquidity events, more recapitalizations as private equity funds are trying to return more capital to their limited partners. On the private company side, we still were expecting the silver tsunami to come, but after several years of COVID, then supply chain, and then interest rates, and then an election, then immigration, now tariffs, we're seeing the folks are still staying on the sidelines. Volatility may be the new norm, but for those companies that are ready to go, there might be an opportunity now. Because deal flow is so far down, supply and demand imbalance has created an opportunity for good companies that are prepared to come to market and really command a good premium. People are chasing what few deals are out there, so valuation for those that are ready could be much higher than would normally be. If we wait a little bit while longer, we see that supply and demand imbalance shifting the other way, such that more deals are coming to the market and demand is constant, and therefore valuation might come down. Might be an opportunity for you to consider. Right now, as we were there for 3 days, the market's turned dramatically with some new announcement coming out of the administration. So still too early to tell on what's going on here, but the tariffs are real. They're not something that's new. So stay informed, stay proactive, be ready to adapt. But what we heard from all of our private equity investor friends is don't make rash decisions. Make them thoughtful, make them for the long term. Make sure you keep your customers close, make sure you keep your employees close, and make the right long-term decisions rather than reacting to what will continue to be volatile for the foreseeable future. So now if you're trying to balance tariffs in the market and everything else, what should business owners do right now? Be proactive. Now is the time to plan and prepare for an exit at some point in the future. It don't even matter when, but now really lay the foundation for that successful exit. In 2025, we have an amazing lifetime exemption gift tax avoidance policy that expires at the end of the year. Now's the time to do your estate plan. Now's the time to gift low basis stock in the company and avoid massive amounts of estate tax. Really take a look at low-hanging fruit. We've said this for years, and we always say this, but if you could find 1% of EBITDA, 1% more profit, and do that this year, next year, and the year after, think about how much more profitable you would be and what that means for valuation. You get credit for that momentum, so be proactive and try to find that. Align your team. Really get your management team together. Think about equity plans or incentive plans for your management team and all of your employees so that they're all aligned at that successful exit. Taking advantage of that now, there's some real tax advantages and some operational advantages to have everyone on the same page thinking like equity owners. So something that you may want to consider sooner rather than later. Most of all, as I just said, is stay adaptable, stay informed, be proactive, get ready for whatever comes next, but with a long-term perspective view. As you know, Carter Morse has been advisors to families and founders for more than 37 years for those that are pursuing their once-in-a-lifetime transaction. If you're considering your once-in-a-lifetime transaction, please feel free to give us a call. We'd be happy to have the conversation and help lay the groundwork as you consider what comes next. We have a lot of fun doing these things, and so look for more coming up later on. Thanks so much.